In the last 30 hours, nearly $4 trillion flowed back into gold and silver. That wasn't traders buying the dip. That's not retail either. That was how capital repositioned after forced liquidation. Just days ago, the metals complex had been violently unwound. Roughly $11 trillion in market value was wiped out across gold, silver, and related assets. Margin calls, volatility spikes, leverage getting flushed out fast and without mercy, and now we are sitting at a rebound. Gold is now up 11% off the lows. Silver is up nearly 20%. Silver alone added roughly $800 billion in market cap in about a day. That's the largest single-day percentage gain since 2008. Now, a lot of stackers are worried about a crash, but these things don't take place at the start of a crash. This happens at the end of a liquidation phase. Violent rebounds in gold and silver don't mean risk-off is over or the crisis is solved. Historically, it means something much more specific. It means the plumbing is starting to unclog. During every major stress cycle, metals stabilize first, because capital needs a place to hide while liquidity stress fades. Gold and silver stop falling, volatility compresses, and only after that does money rotate back into higher beta assets. That's the sequence. Right now, technically, both metals have reclaimed Monday's opening gap. It tells you buyers are willing to defend higher prices rather than waiting lower. Short-term resistance is clear. Gold has overhead resistance around $5.016. Silver around $87.74. Expect turbulence here. Chop is normal. Retests are normal. Sideways movement would actually be healthy. But if this rally is more than a dead cat bounce, silver needs to prove it. This week's key level is $93.18. Next week's confirmation level is $102.22. Above those levels, the structure shifts. The good news for bulls is that the broader trend remains intact as long as gold holds its 50-day moving average. If gold were to close decisively below that level, then silver likely revisits its major trend line somewhere between $66 and $61. At this point, that's not the base case. Under the surface, the physical market is quietly tightening again. Shanghai silver inventories have dropped to roughly 14.4 million ounces after another near 13-ton withdrawal. The China premium, which briefly exploded during exchange halts, has now normalized into the $7, $10 range as comex prices catch up. That narrowing isn't bearish. It's signaling that market is heading towards normalization. And despite the noise, silver is still trading inside a dense support zone around $75, with the next major congestion band sitting between $90 and $95. That range is where this rebound either stalls or reloads. Here's the bigger point most people miss. Violent up moves always come with violent pullbacks. That's not market manipulation. That's how real bull markets behave when leverage builds too fast. What matters is whether the fundamentals change. They haven't. Governments are still trapped in deficit cycles. Growth can't outrun spending. Fiat keeps devaluing quietly while everyone argues about charts. Meanwhile, silver faces structural supply constraints and relentless industrial demand. That's why long-term targets keep reappearing every time price bounces. The move we're watching now isn't about euphoria. It's about reset. Forced sellers are gone. Weak hands are gone. Leverage has been punished. And when gold, silver, and copper all move together like this, it historically signals one thing: stress. This doesn't mean it's a green light to buy blindly. It doesn't mean chase green candles. It means the liquidation phase is likely ending. And the next move will be defined by where marginal liquidity flows once fear peaks.